Hi, I'm Scott Olson, co-founder of LTCshop.com and author of Long-Term Care Insurance Now. In the last episode, I talked about how important it is to make sure that if you're going to buy some type of life insurance policy with some type of a rider, in order to help you plan and prepare for long-term care, make sure you look at the full illustration and make sure you decide to buy it or not buy it based upon the guaranteed values. For example, make sure it's guaranteed to remain in force to at least age 100, preferably age 120. Make sure that the premiums are guaranteed level for life. Make sure that the long-term care benefits are at least 2 times, preferably 3 times or 4 times, maybe even almost 5 times the death benefit. And make sure that the long-term care benefits are guaranteed to grow every year, guaranteed to grow every year to try to keep pace with inflation. And lastly, make sure that the rider on the policy, the long-term care rider, is a 7702B rider. But there are 2 big problems when analyzing these policies. Some of the illustrations are very confusing. Some of the financial advisors selling these policies don't seem to understand how they work. Recently, I had a 64-year-old woman contact me and ask me to analyze a life insurance policy that her financial advisor recommended to her. She has rheumatoid arthritis. She has 2 adult children, and in our discussion, she emphasized that it's very important for her to protect her assets for her children. And she understands that long-term care is a high risk for her, especially due to her rheumatoid arthritis. Even though it's well controlled now, she wants to make sure that her assets are not drained by long-term care expenses. She asked her financial advisor for a quote and information on long-term care insurance. And he recommended that she buy this life insurance policy with a rider that allows a portion of the death benefit to be used to help pay for care. Now, if you've listened to my podcasts, if you've read my book, what's the most important thing to verify when buying a life insurance policy or evaluating a life insurance policy in order to plan for long-term care? The very first question that needs to be asked, and this is the question I asked her. I said, if you pay all the planned premiums on time, is this policy guaranteed to remain in force to at least age 100? And are the premiums guaranteed to remain level? I asked her that question and she wasn't sure. So she emailed me a copy of the illustration that the financial advisor had given her. I flipped through it and found that there was nothing in the illustration that showed the guaranteed values. Nothing. Almost 1/3 of the pages said non-guaranteed, and none of the pages said guaranteed future values. So what do? There's no guaranteed values. Well, first of all, that's probably not going to be the right policy for you. Okay? If you're using it to plan for long-term care, you need guarantees. Guarantees are important. You plan for long-term care once. You buy a long-term care policy once, typically. It usually doesn't make sense to buy more than one. And when you do it, you got to do it right, because there's usually no do-overs. And there was nothing in this policy that showed what the guaranteed values would be. I said, well, okay, none of the values are guaranteed. We're going to have to look at what's called the no-lapse guarantee. Now, the no-lapse guarantee means how long will a policy stay in force if I pay the planned premiums on time every year? In her case, the no-lapse guarantee was 18 years. Her annual premium was $18,922. That's a lot. And she had to pay that every year. And if she paid that every year on time for 18 years, her policy would be guaranteed not to lapse through year 18. But it could lapse after that. Now, I told her that because that's what I read in the illustration. And she said, that's not what my advisor told me. He told me that if I pay the premium for 18 years, I can stop paying the premium after 18 years, and it's guaranteed to never lapse. I replied, that's not what the illustration says. The illustration shows you paying your annual premium every year for 37 years. And even if you pay your annual premium on time every year, after year 18, the policy could lapse due to the expenses. That means you could lose everything you put into the policy. Now, this particular policy did have a rider that would guarantee that it would remain in force to age 120. But that rider would have added another $4,300 per year to her premium, making her premium over $23,000 per year for only a $500,000 death benefit. Was this policy a smart way to plan for long-term care? No, definitely not. Instead of paying $18,000 per year every year for life for a policy that might lapse anytime after the 18th year, she could have gotten a much, much, much better policy. For example, for $18,000 per year for 15 years, only 15 years, not for life, but paid for only 15 years, she could have gotten a policy with $800,000 of long-term care benefits in year one. And those benefits would have been guaranteed to grow to $1.4 million of long-term care benefits by age 85. And those benefits would continue to grow by 3% compounding every year, guaranteed year after year until she passed away. And if she never needed long-term care, her heirs would get back $180,000 income tax-free. And again, all those figures are 100% guaranteed. The figures in the other policy were not. If your purpose is to plan and prepare for future long-term care expenses, you should only buy a policy based upon the guaranteed values. You should only compare policies based upon the guaranteed values. Don't compare one policy with guaranteed values with another policy that has non-guaranteed values. And if you've asked your investment advisor for information on long-term care insurance, and if he or she gave you an illustration for life insurance, please contact me. I'll review it for you at no charge, and I'll help you determine if it meets those 5 criteria that I just mentioned. Thanks.